Markets see profit booking from morning record highs. Mid-cap sees selling, FMCG, auto and financials clock gains, while energy and industrials drag.
The US Federal Reserve kicks off a rate cut cycle with a hefty 50 basis points reduction, its first in over 4 years. But experts don't see big cuts from the RBI and not before the end of this year.
The Supreme Court has rejected pleas filed by Vodafone Idea and Bharti Airtel for recomputation of the AGR dues. The move is a big blow for cash-strapped Voda Idea, which will now find it tougher to compete with its stronger peers.
Andhra Pradesh's new liquor policy gives a boost to liquor makers by facilitating retail sales by private players. This move is seen as boosting volumes in the high consumption market.
Jefferies' chief strategist Chris Wood tells CNBC-TV18 the Fed's rate cut of 50 basis points is higher than expected, most likely due to political motivations. And while he sees emerging markets gaining, he expects higher capital gains tax in India, putting off global investors.
Good afternoon. You're watching us here on Halftime Report. I'm Mangalam Malu, with me Ekta Batra. And as you can see, for the markets, it's all but in the red right now. There have been two halves of the first half of trade so far. The first half was when the Nifty actually went ahead and hit a record high along with the Sensex and other indices. Thereafter, we saw sharp bout of profit taking, which started from the mid-cap end of things. Remember, this week itself, the mid-cap index is lower. And as we speak, is trading at lower levels. 2,000 stocks on the National Stock Exchange currently in the red for just about 380, which are in the green. The Nifty too holding in the green by just the skin of its teeth. As you can see, the crisscross lines far apart right now. The Nifty Bank below 53,000, the Nifty below 25,400. Hi, Ekta.
Hi, Mangalam. Yes, absolutely. It's maybe buy the rumor, sell the news, which is turning out to, turning out in the second half of the trading session, something similar to what we saw in the US markets. For the mid-cap index, like you mentioned, that's a steep cut of around 2.2%. We also have the other indices, such as the small cap index, which has shown a cut of over 2%. Even the Nifty micro cap index, which is down over 2% as well. As you can see, 2.4% hit on that particular index. So as you can see, maybe people are taking profits of those huge gains that they've probably seen in specific stocks today. But let's talk about one particular broader market company. We have Wockhardt, which is the first management on the show. The company's investigational drug, Zenich, or WCK-5222, has demonstrated its ability to cure a complex case of meningitis. It was used on a compassionate basis. To discuss this and more, the possible out-licensing opportunities, we have with us Habil Kharakiwala, the chairman of Wockhardt, who's joining in now. Dr. Kharakiwala, thank you very much for taking the time out. Just wanted to start by getting a sense about how WCK-5222 or Zenich, which is basically an antibiotic, a high-level antibiotic which is used in ICU settings. How did it help a patient with meningitis? What was the kind of recovery that we've seen in the patient? How long did it take?
This patient was put on all other known antibiotics, including some of the newer ones, which were not effective. Finally, a compassionate use was, it was given Zenix, and the patient was completely cured, and it was given for 3 weeks, and then there were no sign of the Pseudomonas organism at the end of the period, and then it has been discharged. Actually, meningitis is a really life-threatening disease problem, and one of the advantages of Zenix is it crosses blood-brain barrier, and that's why Zenix was very effective, and it has a very high coverage against resistant organisms.
Well, Dr. Kharakiwala, I just wanted to understand that now it's been used for meningitis. It's already been used on a compassionate basis for over 30-odd patients, I understand, and that includes one in the US as well. What has been the recovery of all of these patients? And now we're talking about these patients, say 3 to 4 months or maybe a couple of months to a year down the line as well. Give us a sense in terms of where these patients stand post the usage of WCK-5222.
all these patients, 35 of them, the success rate was 100%. And there was no trace of original organism when the treatment was completed. And the duration of treatment was somewhere a minimum of 7 days and a maximum of 70 days. And this clearly suggests that the drug is extremely safe, in addition to be extremely effective.
Okay.
Right.
Well, Dr. Khurakiwala, it sounds like a miracle drug. It sounds like exactly what probably the world needs when it comes to AMR or antimicrobial resistance. So what is stopping approvals at this level, and maybe more commercial use? You've used it compassionately on 30 plus patients. When can we see it more commercialized? And out-licensing opportunities based on the kind of data that you've shown, companies should probably be lining up outside your door.
I think we are at the stage of completing phase 3 clinical trial, which is a global clinical trial. And this should get over in the next 2-3 months. And then we would be in a position to file globally in US and other countries. And that will happen after about 4-5 months of completion of clinical trial. So we expect to be in a global market sometime in 26.
Okay. So in the next 6 months, you'll be in the global market, is what you're saying?
26, I say.
26. Yes. You get that right.
Next about 18 months or so.
Okay. Could you give us a sense of the potential of the drug in terms of market value and also the out-licensing opportunities out here? What is it that you can, garner from this? See,
in US alone, there are about 700,000 patients where our drug will be effective and where no other drug is working. And similarly, India, it is more than 1.1 million patients. Therefore, the opportunity for this molecule is extremely, extremely large. And based on this data, we would be looking for a licensing opportunity sometime middle of early next year. And then we'll see and tell you what happens actually. Would you be able to hazard a, you've given us some indication, 700,000 patients in the US. Would you be able to hazard a guess on the size of this drug? I mean, it can be a broad range. But the cost of this drug in US on the current basis of a new drug antibiotic is introduced is roughly about $8,000 to $10,000 per treatment.
Okay. That's the current antibiotics which are used in the US or in an ICU setting.
But the newer ones. But your
drug is showing more efficacy.
Far more. There is no comparison. Earlier you used the word, it looks like a miracle drug. It is indeed a miracle drug because it has a breakpoint of 64, which is given for a drug in 100 years. So basis the numbers that you're talking about, it seems like it could be anywhere between a $5 to $6 billion opportunity in the US alone. I am not making any comment on this point in time, but I've given the number of incidents as well as the kind of price points there.
Sure. Dr. Khurakiwala, just coming back to that out-licensing opportunity, just based on the kind of statistics that you're providing, I'm interested to know whether pharmaceutical companies have already approached you or not to probably tie up for this particular drug based on the kind of data that you've shown.
To get the optimum value in licensing, it is important that we complete phase 3 clinical trial. That is a major milestone, and when by the time we file to FDA, that is the time we would like to open up and appoint a merchant bank. We are in the process of appointing a merchant banker, and then explore the possibility.
So as of now, there's been no approach. As of now, there's been no pharmaceutical company, say Indian or global, that's approached you for a potential deal on this.
I think number of pharmaceutical company had approached us few years back. And then we had a challenge on valuation, and therefore nothing has happened. because our perception of the molecule is what actually has come out. And I think we would be better off once we complete the phase 3 clinical trial and then approach them through merchant banker.
Okay. Now, just quickly, before we wrap up this conversation, when are you expecting approval from the DCGI, which is the Indian authorities? And when are you expecting approval from the US FDA? Give us specific timelines of these, because US FDA, you have a QIDP status there as well.
So US FDA, as I mentioned earlier, we expect in early 26 because of QIDP status, and the other countries will be a little later. As far as India is concerned, DCGI has given us a permission to undertake a meropenem-resistant clinical trial in small number of patients. And this clinical trial also is getting over in next 2-3 months. And then we will be applying to DCGI. And probably we might be able to introduce in India at least about a year ahead of our international foray.
Okay. Just before we wrap up, Dr. Khurakiwala, I wanted to know, what is the downside risk of this particular drug? You've only spoken about the upside. What is the key risk that you're working with on the downside that this entire analysis or situation that you've put out in terms of US FDA approval, DCGI approval, doesn't come through?
I don't believe there is a downside, because in fact this compassionate use is a far more rigorous than the clinical trial we are undertaking have done. So, and the fact that on a 35 patient, we have saved 35 lives, and we had 100% cure rate, and also that the drug was proved very safe for as long as 10 weeks. Now, antibiotics are not generally given for more than 2 weeks. In rare cases, it is given long. Yet some of these patients were so critical, and they were nearly on the deathbed. And therefore, the patient was saved and got a new life. So this is nearly, most of the cases, we have saved the lives.
All right, take that point. Thank you so much for joining in and giving us the outlook on this drug. Wish you good luck, and more importantly, the medical fraternity, because of the number of patients you said who are suffering from this condition, may stand to benefit from this drug. 26 months is when you expect it, 26 weeks rather, is when you expect it to be launched. In the next couple of months, you will hear from the trials, the clinical trials, which are currently underway in the world right now. The stock seeing a bit of a spike on the comments coming in from Dr. Khurakiwala. Take a short break, come back, get you more on the markets and a lot more stock-specific action. Been some respite for the markets from the lows. The Nifty was at one point, threatening to break into the red, but now from there on, it's seen some bit of recovery, and that's all thanks to the Nifty Bank itself. The only worry is the broader market. So if you look at, the advanced decline ratio, nearly 2,000 stocks declining for just about 400 stocks which are advancing. So those crisscross lines far wide apart right now, with the red one much above the green one itself, and for the third day in this week itself. If you look at, this week, the Nifty is up just about a smidge, 0.2, 0.3%. The Nifty Bank's done well with a 2% gain. The mid-cap and the small-cap indices both down 2.5 to 3% each itself. And today as well, the Nifty Bank saw some profit taking from very close to record high levels. So the previous high on the Nifty Bank was 53,357, and today's high was 53,353. So just 4-point distance between the Nifty Bank today's high and the previous high as well. So those graphics come up for you on the screen. What's important is that it is Nifty weekly options expiry today, and the most active straddle, a call and a put together, are 25,500. The combined premium on 25,500 call and the 25,500 put are together close to around 80 odd rupees, telling you that 25,420 to 25,580 is the range, the broad range that the street is expecting in terms of expiry, and which explains why we saw a recovery from the lower end of the market today back within that range of 25,420 to 25,580 itself. Just keeping an eye out on a couple of stocks. A lot of long unwinding on Vodafone Idea, so keep an eye out on that one. serious amount of short positions built on Indus Tower as well. Vodafone Idea, in fact, is sub 11 rupees, which was the FPO price at which the company raised money recently. So that's a concern. And two stocks which may enter F&O ban. We have Chambal Fertilizers and SAIL as well. So both are the stocks that we will keep an eye out on. But while we're talking about all the other stocks, remember Bajaj Auto hit its fresh all-time high today of 12,054 rupees. Remember, earlier this year, in March itself, Rajiv Bajaj, the MD of Bajaj Auto, said when they had come up with their buyback plan that he thinks the fair value of the stock is 12,000. Lo and behold, 12,000 is here. Today, the stock has crossed that level. So first listen into that snippet of that conversation, and then perhaps we get in Rajiv Bajaj to give us an updated target price, so to say, on Bajaj Auto.
In terms of fair valuation, I mean, without taking any names, all I would say is that in my head, I have a basket of companies that I think Bajaj Auto can be compared with in terms of its performance, in terms of its PE, in terms of its future prospects, let's say, etc. And frankly, to me, although the stock has moved up from 4,000 through 6,000 to 8,000, in my head, and as I said, I'm a layman in these matters, something closer to 12,000 sounds fair value, as you called it. So who knows, there might be another buyback in the near future.
Okay, all right. That was in March of 2024. In fact, let's now cut across to Parikshit Luthra for an exclusive conversation with Bajaj Auto's MD Rajiv Bajaj. Parikshit.
Right, Mr. Bajaj, thank you very much for joining us right now. Yes, in that interview to us in March, you had given us a prediction, maybe jokingly at that time, thinking that 12K might be the right fair value for the stock. What do you think has driven the growth of the company till this point?
It's funny, Parikshit, because when I actually joked about my retirement, people took it seriously. And when I spoke seriously about the fair value of the stock, you seem to suggest I was speaking in jest. But coming back to your question, after I said what I said at that time, Rakesh said to me that both he and our CFO Dinesh received many calls from analysts, and the common theme was the question that what is it you guys know that we don't, So that question comes back to my mind right now, that what is it that they know now that has made 12,000 the price for this stock? And to me, really, it's, we've executed well on all those things that you and I discussed. The Freedom is out there in the commuter motorcycle segment. The new Pulsars are doing really well in the sports segment. As you may have seen, I think you were there day before when Rakesh rolled out the new Triumphs in the premium segment. You know how well the Chetak is doing. You know how well the three-wheeler electric has done in the last 6 months. And while with exports, we are still missing out on Nigeria, but the rest of the world is holding steady. So, as I had said before, we are really firing on all cylinders.
Right, and HSBC has raised its target price from 11,000 to 14,000. That's an increase of 27% for the Bajaj Auto stock. How do you think things will move on from here, and your thoughts on HSBC's latest report?
Well, what I'd like to say in that context is this, that if we step back and kind of look at the big picture of the domestic two-wheeler market, then, there's many ways to segment it depending on what attribute one is looking at. But one very simple, almost simplistic way, Parikshit, is to just break up everything into the commuter space and, let's say, the sports space, So in the commuter space, I would count about 700,000 motorcycles, as I did before when we discussed the Freedom. But I was also add to that about 500,000 to 600,000 scooters, because scooters are essentially just city commuting vehicles. So that's a market size of 1.2 to 1.3 million vehicles each month. And the balance 300,000 motorcycles are, let's say, the sports segment. So if you look at our position till last year, for example, in this humongous domestic commuter segment of about 1.2, 1.3 million vehicles, what was our presence? Our presence was just about 40,000 vehicles, primarily with the Platina motorcycle, and we had virtually no scooters to speak of. Chetak this time last year was perhaps 4 or 5,000 vehicles a month. I think what has happened in the last 6 months, the most significant development now is that both the Freedom as a CNG motorcycle and the Chetak as a electric scooter have both really gained enormous traction. I had said to you earlier this month that after doing close to 10,000 vehicles last month, I'd like to think we can do closer to 20,000 this month. We are hoping to hit 20,000. It's going to be a bit of a struggle, it seems, but we won't be very far from it. Chetak, we are at full tilt as far as capacity is concerned. We are just about crossed 20 and we are struggling to push it above 20. So suddenly from a situation 6 months back when Freedom was not yet in production and Chetak was just about ramping up, you might well see a September in which both put together would be about 40,000 vehicles or a little more. And I think suddenly, at least we feel this, I don't know whether the street sees it like that, that suddenly between these two brands, we have this enormous runway stretching from now 40,000 Platina and 40,000 of this. So let's say 80,000, 90,000 vehicles a month, all the way up to 1.2, 1.3 million. And it's a marketing aphorism that in any segment, the market leader has 40% share and the number two would typically have 20% share. So even if I were to look at it from a 20% opportunity, the question we are asking ourselves within Bajaj Auto now is that in the domestic commuter space, can we do 250,000 vehicles between the Chetak and the Freedom? And why not? So now that's not something for which, you can ask me whether we have a timeline and we have a capex plan. It's not, as crystallized as that. But I think that is the potential before these two brands, and perhaps that is beginning to be sensed.
Okay, so in March you had, and clearly you were well aware of where things will move on in the next 6-7 months. So you said in March that the fair value is around 12,000. Heart of hearts, what are you now hoping for in terms of the next fair value?
Well, again, as I said in March, that I'm quite a layman in these terms. But again, if I go back to both seeing our own situation internally, that we've really executed quite well in the last 6 months. So we've materialized a lot of the potential and are well on our way, as opposed to 6 months back when it was still, kind of just brimming with potential. And if I were to again compare with the new market scenario, because the market has also moved up, so that's no credit to us. And if I look at the basket of companies I was comparing with, then it seems to me as ludicrous, perhaps as 12,000 sounded at a time when we were closer to half that number. It seems to me that something closer to 20,000 is not out of the reckoning. At least in mathematical terms, one can justify it. Of course, the subjective, qualitative, and the sentiment side of things is a different matter.
All right, 20,000 on Bajaj Auto is the new target coming in from Rajiv Bajaj himself, saying that may sound ludicrous now, but given the quantitative parameters and the growth targets that the company has, along with the overall upliftment in the market itself, 20,000 is the target. So he had told us 12,000. The stock was closer to 7,000-8,000 odd in March itself. And now, as the 12,000 mark is here on Bajaj Auto, almost here, he's speaking about 20,000. Let's see whether it happens or not, but we keep an eye out on that one. There has been a recovery for the markets. Take a short break, come back, focus on another important discussion. We have the medical devices industry as it's seeing its strong PE interest. What's keeping this industry abuzz? We have a special discussion lined up for you. Welcome back. Over the last few weeks on Halftime Report, we've been talking about increased private equity investments in certain segments. And this is our special segment where we put you ahead of the curve on what are these underlying opportunities. We've spoken about the consumer space, we've spoken about media, we're speaking about the medical space as well, investments in healthcare, wellness, etc. And today we're talking about the medical devices space. Ekta, first roundup of the opportunities and the sector itself.
Well, yes, it's an interesting space. The medical devices industry is seeing strong PE interest. There have been around 59 private equity transactions in the Indian medical devices space since 2017, with PE deals in the space surging by around 3.3 times compared to pre-COVID-19 levels. Now, some of the prominent deals have included Warburg Pincus investing around $210 million in Merrill Life Sciences, which is one of India's largest medical device manufacturers, $300 million in ophthalmic equipment manufacturer Appasamy Associates. Additionally, Samara Capital has invested around $150 million in stent manufacturer SMT, and one of the most notable and recent has been KKR's acquisition of Healthium from Apex Funds, valued at over around $800 million. Now, Indian companies have largely focused their efforts and consequently deal activity on medical consumables and mid-range medical equipment. Medical consumables primarily encompass single-use or disposable products like syringes, IVs, surgical blades. Higher-end equipment produced by Indian companies includes stents, ventilators, X-ray machines and diagnostic equipment. So why is there such strong interest in the medtech space, particularly in medical consumables? The Indian medical devices market is valued at around $11 to $12 billion, and it's amongst the fastest growing globally, with an estimated CAGR of 10 to 12% from 2024 to 2030. Now, within this market, the medical consumables and implant segment is projected to be worth around 4 to 4.5 billion, growing at 10% CAGR. Currently, India is one of the top 10 manufacturers of medical consumables worldwide. Indian manufacturers benefit from lower production costs, skilled labor, and competitive pricing, which has led some investors to liken the sector to the generics industry of the 1990s. However, there are challenges and trends to consider. Investors emphasize the need for companies to enhance their technology capabilities and be mindful of competition from China, which is considered a decade ahead of India in this space. Additionally, India's ability to move into higher tech sectors where multinational corporations hold an 80 to 90% market share, such as specialized devices and high-end surgery accessories and consumables. So while investors expect strong private equity interest in the medical devices sector over the next 5 to 10 years, one cannot rule out pharma or healthcare companies throwing their hat in the ring as well. A recent example has been Alchem tying up with US-based Exactech to manufacture their joint replacement implants in India, to Mankind having been potentially interested in Healthium as well. Let's wind this down with the near-term deal potential pipeline. Possible deals could revolve around the acquisition of India's largest cardiac stent manufacturer, SMT. KKR, TPG and Alchem are reportedly in the race to acquire the company. Other anticipated deals include Everstone's plan to merge Translumina with Everlife Holdings, a distribution platform, and eventually list the merged entity. Additionally, medical equipment manufacturer Scanray, which counts notable investors such as Arun Kumar of Strides Pharma amongst its backers, is another name to watch out for in terms of potential M&A.
All right, so that setup that we've seen for the medical devices itself. Let's keep an eye out on that, and let's take a short break. On the other side, we'll have important guests joining in as well to discuss the opportunity here in terms of investments and some of the challenges in terms of scaling up as well. Stay tuned.
Welcome back. Well, let's continue our conversation about the medical devices industry and the kind of PE interest that we've seen. To talk more about it, we have Kevan Movdawala, healthcare sector leader and partner EY, Ernst Young, India. And we also have Anish Bafna, MD and CEO, Healthium MedTech, who's with us. Anish as well as Kevan, Thank you very much for joining in. Kevan, we've had these conversations for a long time. We've moved from talking about hospitals to now medical devices.
Right.
Medical devices are seeing a lot of private equity interest. Give us a sense in terms of why and how much more can we see?
Sure, I think there are 2 or 3 things, and we've got to look at it from the demand-supply side, right? So on the supply side, traditionally it's been an MNC-dominant system with a very fragmented Indian supplier system.
Right.
Now that's changing. I think the number of companies who've scaled more than 100 million are almost 4 times what it was in the past. The Indian companies have been growing at late double digits versus MNCs where the growth has been slower. I think the big catalyst is on the demand side, where hospitals want to embrace Indian products given institutional pricing pressures, changing business model towards mass healthcare, penetration of Ayushman Bharat, right? So I think that's really driving this shift. Interestingly, we spoke about private equity money, 60 transactions, close to 3.5 times interest compared to pre-COVID. And I think the last point, Ekta, I'll cover is that, we are still a minuscule percentage of the global market today. We are 1% of the global exports. China is 10x of us. So the generic pharma story, which has worked well for India, I think med devices is going to see that headroom. So very soon we are going to be Make in India, made for the world. And I think the vision for the sector is to move from a 3 billion to a 25 billion industry over the next 5 years, actually capturing nearly 5% of the global market is what I see with the blend of private enterprise, institutional reforms, and also a larger ecosystem play.
So $3 billion turning into $25 billion. Anish, one likens this to how the generic market grew in India for the world as well. What from that can we learn to ensure that this growth also is a lot more strong, a lot more sustainable, and perhaps can be a lot bigger as well? What are the lessons that one should learn from that?
It's a very right sort of simile, because we are exactly where Indian pharma was about 30 or 40 years back. And currently, I think this is a transformative period for the Indian medical device industry, right? I mean, historically, the med device ecosystem has been heavily import dependent. 70 to 75% of what we use in this country is important, and that has been traditionally dominated by global multinationals. Right? With the ever-expanding healthcare provider space and network, there is an increased requirement for products to be manufactured in India, to be supplied here, high-quality products at affordable prices. And which is where you're seeing consolidation happening. You're seeing the private equity players also playing a very important role. But what we are seeing currently is the development of an ecosystem in India. A lot of players, there are about 3,000 now registered players as far as med device are concerned. And the beginning has started with surgical consumables and products that are used in infection prevention and the likes. But over a period of time, the ecosystem will get fostered. And as more components come in, as the captive consumption of the domestic market increases, we will see a lot of scale players who are able to do exactly what pharma did in the international environment and take share from large multinationals in Europe, US, and other parts of the world.
Okay. Well, Anish, Healthium itself has had a very interesting story. It's gone from Apex to now KKR. Give us a sense in terms of how exactly the private equity money changed the course of the company, and where would you rank Healthium in terms of the products and the services that you're providing today as compared to the global peers?
Right. So, our story predominantly started in 2018. And in the fragmented market like India, the medical device industry, as I said, was predominantly multinational driven. Our vision was to create an independent Indian medtech company that not only caters to the Indian population, but creates strong products that can be taken internationally as well. And, we started through the acquisition route. We acquired 3 companies, 2 in India, 1 internationally. And over a period of the next 6 years, we were able to make 3 more acquisitions, make a divestiture. And as an organization, we've remained very focused on the surgical portfolio. So, over what was earlier a sutures manufacturing company is now having 4 different verticals. We have advanced surgery, which is everything to do with wound closure. We have wound management. We have created an arthroscopy portfolio from scratch arthroscopy globally is about $5.5 billion market. And these are difficult to manufacture products. So, our view was India has the ecosystem in terms of the necessary skills, whether they are polymers, chemical, metals, and the likes. You have a lot of regulatory experience in this country, and if you are able to harness it, we can create a medtech company of scale. So we have arthroscopy, and then we have infection prevention. And that journey sort of has allowed us to grow the business double digit, both on the top line and the bottom line over a period of the last 6 years. Now, we've grown our top line at about 20%, our bottom line at about 24%. And we've pivoted the company internationally, where 50% of our overall sales comes from the international market. We are now present in about 90 countries. We have about 85 patents. And all this was possible only because of the infusion of private equity money, which sort of allowed us to create this platform, both through the acquisition route and organically, and gave us sort of the funding to grow internationally as well. As we speak, we are the largest manufacturer of suture needles in the world, and 1 in 5 surgeries globally uses a Healthium product. So it's been a very interesting journey, and I really think that we've just started scraping the surface, because we cater currently to a TAM of about $15 to $16 billion globally, and with certifications like US FDA, UMDR. The global network has really opened up for us, which is where we see a very large part of our growth coming for the next 10 to 15 years.
Right. We'll, ask you for your experience on this one as well. But coming back to you, Kaiwan, one of the things is that the perception issue. Earlier, it was because it was MNC dominated, people associated MNC with a certain quality, India with a certain quality. How do you ensure that the perception of Indian quality being at par, if not better, than the MNC quality is tackled?
No, I think that's an excellent question. And I think there are 2 or 3 elements to that response. I think one is really credible data. I think Indian companies have been spending on R&D, even up to 5% of revenue, to generate data on technical equivalence. I think that's extremely critical to boost what I call hand loyalty, right? Surgeons who are getting trained at medical colleges, catch them young. I think data is one. Second is robust manufacturing capacity and capability, right? The regulations, whether it's US FDA, accreditations around EU MDR, C, I think will play a very significant role in narrowing this, perception gap. And I think third most critical is to have a very wide and deep product basket, right? Which covers at least 30% of the TAM, which gives confidence to the surgeons that these are products which are credible. And I think finally, the companies in this space need to have a very singular vision. Can I be the one-stop OT provider?
Correct.
Can I be the one-stop ICU provider? And provide products at scale with the right element of scientific selling.
Okay. Anish, just before we wrap up this conversation, we are fantastic when it comes to medical consumables, products which are probably used outside the surgery and to a certain extent used inside the body as well, such as, say, stents. But we still haven't reached high-end medical manufacturing, which is dominated by MNCs. When does that shift happen, and will that shift happen?
Ekta, I think we are, poised for a multi-decade growth opportunity. The beginning always starts with consumables, products that are relatively easy to manufacture, that are able to harness the local ecosystem. But over a period of time, we will see the emergence of several players across subcategories who will position themselves globally. And, we have all the necessary raw material in place to make sure that we are able to make cost-effective and scaled manufacturing facilities that are able to cater to different kind of product categories in the future, right? I think the growth vector will get accentuated by this entire Make in India effort. And currently it's both Make in India and Make for the world. And what will further sort of accentuate this is our spends on R&D. If we as a company are spending roughly about 4 to 5% on R&D, and which everybody else is. So what I feel is that, our capabilities towards bringing innovative products is increasingly becoming better. We are having more collaborative efforts between industry stakeholders as well as the government, and the government's proactive stance to the sector becomes fundamental, right, for this kind of transformation to happen. So you're seeing a lot of work around infrastructure development, facilitating R&D, attracting FDI, promoting sectoral skilling. So, with initiatives like PLI, the establishment of medical device parks, we will slowly see the formation of an ecosystem. But ultimately, what is very important is the captive consumption of the domestic market, right? I mean, the reason China grew is because the domestic market was very, very strong. As we are able to get a better foothold domestically and take share from multinationals, I think it's a matter of time where you will see a larger slew of products coming to the fore.
All right, Anish, as well as Kevan, a pleasure speaking to you all on the medical devices industry. And I'm sure this is one of many conversations considering the kind of growth that we're seeing within this space. Thanks very much for taking the time out and speaking with us. Well, on that note, we need to take a short break, but we'll get you more on the markets, a lot of stocks in focus. Stay tuned. Welcome back. Well, let's shift focus to the commodity space now. Manisha joins in, and today she is focusing on zinc.
Well, I'm looking at zinc prices, which even after a bit of a decline overnight after the US Fed meeting, are even now trading at a 3-week highs. Well, if you look at the year 2024, the high for this year has been $3,100 a ton. We did see a low of around $2,300 as well. But currently, we're looking at prices trading at $2,900 a ton. Well, the all-time high clearly was in 2022 at $4,600. So we are off those kind of numbers right now. Well, a few factors which are supporting zinc prices right now is the stimulus measures expectation from China, because all the data that has come in from China for the month of August and until mid-September has been on the weaker side, with expectations that China perhaps will do something more here. The second is Orda Zinc Norway smelter. The expansion now is getting delayed to 2025. So that means that the supplies would not come, which the street was accounting for in this year itself. The third thing is that the global zinc market seems to be tightening right now, because in the month of June, you are looking at surplus of 8,700 tons, while in the month of May, it was at 44,000 tons. So clearly, that is what the reaction that we have seen come in the prices already. If you look at the China zinc refined production for the month of July, also has seen a decline by more than 10%, also adding support to prices. Well, the LME inventories have continued to gain, though, up by nearly 2.5% on a month-on-month basis. But the street does believe that going forward, as we see infrastructure and demand within steel as well, so for galvanization as well, you could be looking at zinc demand continuing higher, and the support thus could continue.
Okay, all right, Manisha. Thanks very much for that. We'll take a short break. More on the markets once we're back. Stay tuned. Welcome back. Well, still under pressure for the mid-cap index, which is down around 1.4%. But there's a marginal improvement which has taken place in the advanced decline ratio. So that should come up for you. There were less than 1,000 stocks which were declining on the Bombay Stock Exchange. So there's a little bit of an improvement. Nothing really to write home about at this point in time, which has taken place on the advanced decline ratio. Otherwise, the Bank Nifty is one of the indices which is managing to hold up quite steadily. So up around 0.4% currently for the Bank Nifty. Well, on that note, we need to wrap up on halftime report. Business Lunch will take all the action ahead.